Watching a portfolio get whipsawed by violent, unpredictable price swings feels like a trap constantly snapping shut. These sharp movements are part of a deliberate liquidity hunt, where market makers target specific price levels to trigger high volumes of buy and sell orders. This search for liquidity is often dictated by the S&P 500, which currently serves as the master trend for the broader crypto market. On the 4-hour chart, the S&P 500 is locked in a macro bearish trend, but the momentum indicates into the oversold zone below 30. Historically, an oversold signal on this time frame suggests that the immediate selling pressure is exhausted, pointing toward a short-term pause rather than a total market bottom. When traditional markets reach this exhaustion, it creates a temporary window of relief that allows Bitcoin to stabilize before the larger bearish pressure returns. Bitcoin is currently caught between a heavy long-term trend and the tactical requirements of short-term survival. While the weekly chart shows a massive bearish divergence, Bitcoin has consistently defended the immediate support zone between 65,500 and 66,000 for nearly 2 months. The recent move down to 65,400 was designed to trigger a cluster of over-leveraged longs, clearing that capital before the price stabilized. That move was immediately followed by a reversal to 67,400, slaughtering the shorts who piled in during the drop. With both sides of the leverage cleared out, Bitcoin has entered a liquidity vacuum where no significant clusters of capital are sitting close to the current price. Neutralizing these emotional positions leaves the market in a state of sideways, range-bound trading, allowing calculated participants to dictate the next move. To find the next significant pool of volume, the market must look toward the 72,000 level, where the next major liquidity cluster resides. Reaching that target requires pushing through a gauntlet of historical resistance at 67,000 and 69,000, levels that previously rejected upside momentum. Navigating this high-resistance chop requires a platform that can handle precision entries and exits without delay. Traders often utilize high-liquidity exchanges like BingX to manage these specific range-bound setups while keeping fees at a minimum. Using the partner link below provides access to deposit bonuses and entry into a dedicated network for sharing trade execution signals. Even a perfect market map is ineffective without a platform that executes accurately. Failing to secure both often results in a trader becoming part of the liquidity the whales are hunting. The altcoin market is currently showing a contagion effect, with major assets shadowing Bitcoin's price action almost perfectly. Ethereum's ongoing defense of the 1,910 to 1,930 support zone mirrors the stability seen in Bitcoin, reflecting a lack of independent momentum for now. XRP is in a similar position, currently testing a massive multi-month support level at the $30 mark. While XRP's price has created lower lows on the 4-hour chart, the momentum indicator has started trending upward, forming a bullish divergence. If the $30 support fails to hold, XRP faces a gap in historical volume that could lead to a swift move down toward the next key level at 1.13. In this environment, altcoin support levels rely entirely on Bitcoin's macro floor, making strict confirmation a necessity before taking any trade. Solana is currently flashing a 4-hour bullish divergence that is nearly identical to the setup on XRP. Its current trading range is tightly defined, with support between $75 and $80 and heavy resistance waiting at the $95 to $105 mark. Chainlink serves as a clear example of current market paralysis, having remained trapped between $7.90 and $9.50 for nearly 2 months. Managing a short-term bullish divergence during a larger macro pullback requires a different strategy than trading a trending bull market. Survival in this range means trading the immediate boundaries and taking profits at resistance rather than waiting for a long-term breakout. Navigating these cycles is about identifying short-term relief bounces engineered by market makers and securing gains before the broader trend resumes.